Do you ever wonder if there is a framework that you can use to understand why price move up, move down, and sometimes just get stuck in a sideways range so we can use to create an edge out of it and help us be able to trade all market conditions? In this video, I will introduce you to a framework known as auction market theory. So what is auction market theory, also known as AMT? Auction market theory is basically a philosophy, a framework that says the market is an auction, supply and demand. Buyers bid price up until no one wants to buy higher. Sellers push price down until no one wants to sell lower. This process creates two states of market known as balanced market and an imbalance market. For example, gold is selling at $1,000, and as sellers are being aggressive and pushing price down to $500, sellers are starting to dry out and someone come in and say this is too cheap for gold, and they will buy it all up, causing price to rise higher. And as price is rising, again, buyers are drying up. Someone come in and say this is too expensive for gold, and then they go and sell it off, causing market to drop to $1,500 for gold. And as price is at this level, the market is happily transacting back and forth. This is what is known as fair value. In another word, a balanced market. Fair value is basically price levels where both buyers and sellers agree the most. It's where the majority of trades happen because neither side sees a big advantage in pushing price higher or lower. Think of it like the going rate in an auction, the level where everyone accepts as reasonable. If we take a look at this graph, it's more similar to how the market would move when you look at the chart. So the market lost fair value. The market will continue trading back and forth in this balanced range until a news driver or one side gets more aggressive, pushing price into a state of imbalance, breaking out of this range. And from this breakout, price will continue to stay in this imbalanced state until it reaches a previous balance area, or it will create a new balance area, and it will continue trading back and forth in this range again until again one side gets more aggressive or a news driver come in, and then price will get pushed out of the range into an imbalanced state. And the market just continued back and forth, moving from balance to imbalance to balance to imbalance and to balance again, rotating between balance and imbalance. The market loves to stay in balance or fair value. That's why you tend to see the market ranges more than it trend. And if you're an ICT trader, I'm sure you recognize this image here. It's basically a market maker model diagram, right? So auction market theory been around for a very long time, since the 1980s. When the market is in a balanced state or gets stuck in a range, ideally you would want to be buying at the bottom of the range and selling at the top of the range. Target would be the middle of the range or the other side of the range. And this is when people apply strategies like mean reversion or liquidity sweep. And as the market is out of balance range into an imbalanced state, you want to trade a continuation until price reaches a previous balance, or it will start creating a new balance. Okay, so that's the theory part out of the way. Now let's talk about some of the tools that people use to visualize the market. Some people use just candlesticks, but the two most common tools that you will see auction market theory traders use, which are volume profile and TPO, time price opportunity. These are not indicators. They don't give you buy signals or sell signals. It's just a different way of visualizing the market, just like using the candlesticks. TPO, time price opportunity. This profile will measure how much time has spent at each and every price level. The more time has spent at a price level, the wider the profile will be at that level. And volume profile, on the other hand, instead of measuring time, it measures volume. So the more volume is spent at a price level, the wider the profile will be. Now I will make future in-depth videos on each of these profiles and how you can use them and how they work, each and every element of the profiles. But I'm not going to do that in this video to keep the video short, because people don't like watching long videos. In a moment, I will also show you a trade that I took using volume profile and auction market theory combined. But auction market theory traders will use tools like TPO and volume profile to get context and levels to trade from, and then they will use tools like footprint, heat map, or DOM, depth of market, or just candlestick to confirm their trades. Again, in the future, I will make a video on each one of these tools and how you can use them They may look complicated, but I promise you it's not. So let's talk about the trade that I took yesterday. This is ES 5 minutes chart, but the time frame doesn't matter because volume will stay the same in every time frame. And this is a Sierra chart. I just use this to analyze, then I take trades on Top Step or whichever platform. But you can use any platform as long as it has volume profile tool, and this will work on any asset. But before I go ahead, let me just briefly explain what you're seeing on the chart here. So in every volume profile, the platform will mark out an area known as value, and it's the 70% of the majority of the volume in that profile. In this profile, you can see here, the white shaded area is the value area. The line at the bottom is value area low. White line at the top is the value area high. And in the middle is the point of control, also known as POC, which is the highest volume traded. And on my chart, you will see a red and white profile and a gray and white profile. The red and white profile is just the extended hours, and the white and gray profile is the RTH session. So when I was looking at the chart, I could see that price was ranging in this balanced state, creating a bell curve shaped profile. And as price attempted to try and come out of fair value, couldn't sustain and fell back in. And as price came back out, I was looking at the chart thinking with the same logic of AMT that price is not going to be able to sustain outside of the fair value because we're in a balanced profile, and that price will drop back in either to the POC or to the value area low. So as I was watching the chart here, I could see that buyers were pushing hard. There were big buyers here, but price was failing to go up, and then aggressive sellers came in. So I just took a trade, and my target was the bottom here. And if you can see, just before market open, price came back and tapped the value area high again, and then continued to drop as market open. And after market open, price continued to trade down here, then got pushed back up into previous value. And price gave a tap here, as you can see. I wasn't on the chart, but if I was on the chart and there were signals for me to confirm the trade using order flow, I would have took the long and probably target POC or the value area high of the previous profile. But yeah, there you go. It's just a brief explanation of the trade that I took and how I use volume profile and AMT together. This is why I love auction market theory so much, because even when it's in a ranging market, we can still trade. Even when it's in a trending market, we can still trade. It gives you a real edge over the market rather than just trading trending market condition only, which doesn't happen too often. I've made a Discord channel for you to join. I'm not charging anything, but in there we can talk more about trading and you'll get updates on my future videos. Other than that, make sure you subscribe, like, and turn on the bell notification so that other people can see this video too. Goodbye for now.